Hi everyone. The mistake that's costing you six figures. If you're under 40 and haven't started investing yet, you're about to make the same mistake 77% of investors regret for the rest of their lives. And here's what makes it worse. By the time you realize what you've lost, it's too late to get it back. We're not talking about picking the wrong stock or timing poorly. This is way more expensive than that. Most people don't even know they're doing it until decades have passed. The foundation wealthy investors build first. Here's what separates people who actually build wealth from those who just talk about it. Before buying a single share, before researching funds, before opening any account, there's a foundation that determines everything. Skip this and you'll sell at the worst possible moment and you'll quit forever. Get this right and you can sleep through crashes while your money keeps growing. Build a cash cushion first, 3 to 6 months of essential expenses. Without this buffer, you're investing with money you might need next month. That creates fear-based decisions during downturns. A modest emergency fund transforms your psychology from anxious to confident. Confident investors get rich, anxious ones stay broke. The question that determines your strategy. When will you actually need this money back? The answer controls your entire approach. Money needed within 5 years should touch volatile assets. Saving for a house down payment in 3 years? Keep it in high-yield savings or treasury bills. Stocks will crash right before you need that cash, and you can't afford to lose 20% when buying property. But money you won't touch for decades becomes completely different. Time transforms volatility into consistency. Short-term swings smooth into long-term gains. Young investors possess the most valuable asset in finance, and it's not capital, it's time. Each year you delay costs you exponential growth you can never recover. This is the regret, not what you bought, what you didn't start. Why smart people stay broke. The biggest lie holding people back is waiting for more money. They'll invest when they get that promotion, when they land the better job, when some future windfall arrives. Meanwhile, someone else starts with pocket change today and quietly builds wealth while they're still waiting. Check this math. Someone contributing $100 monthly at 8% annual returns accumulates over $149,000 after 30 years. They only deposited $36,000 themselves. The other $113,000 appeared through pure exponential growth. Money made money, which made more money, creating momentum that accelerates yearly. But only if you actually begin. The tax trap beginners fall into. Most new investors open regular taxable accounts and start buying, creating unnecessary tax obligations with every transaction. Each time investments generate profit, taxes claim a portion. Across decades, those tax payments add up to massive wealth lost. Smart investors use accounts specifically designed to shelter growth from taxation. Whether maximizing employer retirement matches or opening tax-advantaged accounts independently, this single decision adds six figures to your final balance. Yet beginners ignore it, preferring to overpay taxes rather than spending 15 minutes setting up the right structure. Where to actually put your money? This is where beginners freeze. They've built their cushion. They've opened smart accounts. Now they're staring at thousands of investment options with zero idea what to choose. So they either guess randomly on individual stocks or get paralyzed doing nothing. Both fail. The solution? It's simpler than you think. Forget individual companies entirely. Buy index funds owning the entire stock exchange. 500 to 300 companies simultaneously. You're betting on broad economic expansion instead of hoping one specific business succeeds. Now, here's the controversial part nobody wants to hear. Most dividend investors are doing it wrong. They chase the highest yields without understanding they're buying companies that can't afford to pay those dividends long term. High yield often signals financial distress, not strength. The Schwab U.S. Dividend Equity ETF, the ticker is SCHD, it takes the opposite approach. Rather than chasing maximum yield, it filters for companies with sustainable dividend histories and genuine financial strength measured by 4 key metrics: cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. SCHD currently yields 3.79% with an expense ratio of just 0.06%. These aren't desperate businesses bribing shareholders with unsustainable payments. They are profitable enterprises like Bristol-Myers Squibb, Merck, and Cisco generating real cash and sharing it responsibly. Those quarterly payments reinvest automatically, purchasing additional shares that generate more dividends. A $10,000 SCHD investment generates $379 in annual dividends initially. Based on historical patterns, that income stream has the potential to grow substantially over time. Combining total stock exposure with quality dividend payers creates intelligent balance. You capture overall growth while constructing an income stream that can expand alongside your portfolio. Stop chasing the highest dividend yield, start buying the highest quality dividend growth. Wealthy investors don't rely on willpower, they automate. Set automatic transfers from your paycheck straight into investment accounts before you can spend it. The money disappears before temptation arrives. No monthly debates, no excuses. It simply happens. This system delivers another massive advantage. When stocks plunge and fear spreads, your automation keeps executing. You're accumulating shares at discounted prices without forcing yourself to act courageously during frightening times. Let me guarantee something, stocks will crash while you're invested. Not maybe, will. Your account balance will drop hard, 10%, 30%, maybe more. Watching wealth evaporate overnight triggers primal fear. This moment separates winners from permanent losers. Amateurs flee, sell everything, lock in losses, quit forever. Here's historical truth. Major U.S. stock indices have recovered from every crash in history. Some rebounds happened within months, larger collapses took years, but they all eventually recovered and climbed higher than before. Investors maintained their positions, came out ahead. Those who sold guaranteed their losses became permanent. This explains why emergency savings matters so dramatically. Car breaks down during a downturn, pay with reserves, not by selling investments at terrible prices. You can afford patience when others flee because you're financially secure. If you're serious about avoiding the 77% regret, here's your exact sequence. First, verify emergency savings exists, covering 3 to 6 months of expenses. If missing, build it immediately. Second, eliminate expensive debt exceeding 8% interest. Credit card balances at 22% sabotage future returns. Kill them first. Third, open tax-advantaged accounts, 401k, IRA, Roth IRA, or equivalent. Maximize any employer match immediately. That's free money. And fourth, establish automatic contributions for whatever your budget allows. $50 monthly beats zero. For actual investments, maintain brutal simplicity. Allocate half to a total stock index fund like VTI. Allocate half to SCHD for quality dividend income. 2 funds total. That's the entire strategy. No overthinking, no constant adjusting. Review quarterly and not daily. When stocks inevitably crash, take zero action except maintaining automation. Wealth doesn't come from perfect timing or selecting winning companies. It comes from starting early, staying consistent through volatility, refusing to quit when fear dominates headlines. The mathematical reality is brutal. Starting at 30 versus 40 costs you over $200,000 in final wealth with modest monthly contributions. The 10-year delay doesn't just cost 10 years of contributions, it costs 10 years of exponential growth on those contributions. The 77% waited for the perfect moment. Perfect conditions, perfect knowledge, perfect confidence. None of it came. They weighted themselves into permanent regret. Don't be them. Start today. Disclaimer, this is educational content only. Past performance doesn't guarantee future results. Historical SCHD dividend growth doesn't ensure future increases. All investing carries risk, including principal loss. Consult qualified financial advisors before investment decisions. This is InvestED, portfolio construction surviving market chaos. Smash that like button, share this conversation strategy, and subscribe for wealth building intelligence. Converting assets into income, investing smart, profitable investing.